Howdy, Jacob here. Today we're looking at Liberty Energy in the energy equipment and services industry. Essentially, same market cap and enterprise value at 3.5 billion. Founded in 2011. We're looking at a pretty recent company here. Looks like they provide hydraulic services and related technologies to onshore oil and natural gas exploration. A lot of these companies have had just stupendous growth recently, which has been or throughout their young lives, which is very interesting. From a making money perspective, it looks like in the recent 2 years they've been making a plethora of money, but before that, uh, not as much or even pushing into the negatives. So um, we're just looking at a cyclical business here where even gross margin can be negative 5.7%, minus 7.5%, but then as high as 20%. So interesting business here. Definitely not as consistent as some of the other ones we've seen in this screener, but we are seeing pretty heavy growth in gross profit, growth in operating profit, and net income. And then the shares, at least the last 3 years, have been pretty consistent. So that's impressive. There was pretty big growth here. I wonder if they did an acquisition in 2020, which I do not see. So just heavy issuance of shares. Um, Balance sheet has 37 million cash on hand with 140 million long-term debt, no short-term debt. So that 140 million could be paid off in their rolling 12 easily. So no concern on the debt side as long as the company produces these positive free cash flow, because we do see that capital expenditures have been growing immensely. And so if their cash from operations falls to what it was before, and their capital expenditures aren't lowered, then they could have trouble. But here is just where me as a conservative investor, is just going to be using averages here because I'm just not entirely confident based on the numbers that this is just going to be entirely sustainable for the projection period of 7 years that I use. So let's start making some assumptions. I think on the revenue side, they just grown so much recently. I think it's just going to be one of those things where maybe they go down in the near future, but then come back up later, or maybe just small growth. Let's do 2 and 14, and this is just saying, yeah, there's been an immense amount of growth, but I just am not confident that they'll be able to grow as fast into the future. And if they do, they might have to take a hit in the near term, just because inflation has been so high, demand has been so high that it might just calm down to reality, and then the growth after the 7 year period might be more in line with the average company. And then on the margin side, 5, 3, let's do 5 and 4 with share change of minus 2%. If they're buying back 2% of shares, that's going to be about 70 million, which, I mean, yeah, they can absolutely afford that in the rolling 12. But again, on your 5 year average, that's going to be a good amount. So let's keep that the same. And then the dividend paying out 38 million. I mean, they just don't have a long, consistent history of dividends. So I'm just going to assume it's the same. And these more cyclical businesses are just harder to evaluate based on numbers. It's definitely easier when you can actually look at the reports themselves and figure out from there. But it's just not my way. I definitely like to look at the numbers first and make it look almost entirely obvious, to where once I do the review, or I'll do a review once the numbers look entirely obvious, and it's just not entirely obvious for me at this moment. Hopefully you enjoy the video and have a great rest of your day. Thank you.